Good morning, Australian expats. My name is Jeremy Harper. Joining the hot seat today, we've got Mr. James Ridley. It is the 16th of August and we are 16th of July. Sorry, got ahead of ourselves. I'm thinking about the RBA upcoming meeting.
Too
But here we
excited.
are giving a little bit of a market update. How are we, James?
Yeah, good morning, mate. Cold, actually. I feel like we've been smashed by a cold snap on the East Coast the last week. My little son, Harvey, keeps waking up probably from being too cold throughout the night. He is only 11 months, so I'll cut him some slack. But, mate, we're into it. There hasn't been too much that's probably
Yep.
happened since our last episode. We know we've got some more data coming out later this month, and the important one there is the June quarter CPI, the quarter, not the month. And that's obviously what the RBA will be using as a way and guide to decide whether they increase interest rates or cut them or stay hold. But since last week, Cotality, formerly CoreLogic, they put out some more rental information around how the rents are tracking at the moment. So I think we'll jump onto that one shortly. But then had a few client scenarios come through that I want to unpack with you, but a bit of Q&A as well. So good session
Yep.
to run through today, mate. Why don't we jump into it? RBA, where are we heading? How's it looking at the moment? How's the rate? How's even the rate tracker looking? When is the next decision?
Yeah, so I got a little slip of the tongue earlier. So the next meeting is the Tuesday, the 11th of August. So
Yep.
we're a couple of weeks away. And as you said, the 29th of July is the big data print for the CPI. So I guess
Yep.
everyone's holding their breath until then. You know, what's happened since the last meeting is obviously we went through the Cotality data last
Mm.
episode, but you've
Yep.
seen what's happened nationally to the house prices. That
Yep.
has cooled off.
Yep.
So I think
That's
with that, and then we'll get this CPI printout, and that will give us a really good read into what's going to happen in August with the RBA.
Yeah, the looking at the rate tracker at the moment, 81% no change, 19% chance of it going up to 4.60%. So market is thinking there'll be no change at the moment.
Mm.
Watch and keep an eye on that after the inflation readout. I think it'll jump up a bit, to be honest.
Yep.
Again, I just think the June quarter is going to be quite nasty. I've been saying it for the last couple of weeks, to be honest, just because of all the Middle East conflicts, fuel
Yep.
prices, all those sort of key elements will be in there. But when we look at those data points, what else is coming out later in July?
So we do have the unemployment figures for the June. So obviously it's sort of kept around itself around that 4.4% for May. So
Yep.
again, that will feed into the RBA's decision. I'm really
Mm.
intrigued to see with the CPI if the RBA already has, they've got their band, but I'm sure they've got a number they've discussed that where they're comfortable, where this print will come. If it's higher than they're separate to the band, maybe they'll
Yep.
they'll keep a hold. I still think there's going to be a hold unless it's,
Hmm.
as you said, I think it's going to be nasty. They're anticipating that, but we'll see. A couple of weeks ago.
Yeah, I know. We're all holding our breath for it at the moment. I feel like a lot of first home buyers, mortgage holders at the moment, they're waiting for a bit of reprieve and see those interest rates drop because right now it's probably at a bit more of a higher level in the last, obviously, 7, 8 years. So if it goes up, there's definitely going to be a fair bit of pain. Last week, we did touch on the property market cooling off a bit, and I think it's important to zoom out. This time of the year, it usually does cool off because of winter, and it's not usually what we'd see typically as listing seasons. Spring and summer are coming, but they're still obviously a few months away, and that's when things will start to heat up again. Right now, obviously, it's where buyers agents really probably do good work for a lot of their clients because a lot of off-market purchases are happening, and EOIs are generally happening as well. But
Yep.
when we look at the recent, I guess, data that's come out again from Cotality, a bit of a rental review, giving us some figures there.
Yep. So for the June quarter, rents were up 1.6%. So
Mm.
annually, we're now looking at 5.9%. So it's quite an aggressive growth. And as we said previously, that will feed back into our CPI. So higher rents
Yep.
will mean higher inflation for everyone, which will put pressure on the RBA and what they decide to do. I think if you look at national median rent now, it's $705 a week, so up 40% over the last 5 years. So what you've heard in the news around people are really suffering, the renters out there, that is correct. That is
Yep.
correct, not just homeowners.
Yeah, that's right. And unfortunately, what we've seen in the past, not just in Australia, but also over in New Zealand, based on that recent policy change, negative gearing, those sort of things, it usually does push up rents pretty quickly, to be honest. So, and that's obviously not going to help CPI. So it's just a cause and effect there that's going to play out in the next couple of years. But we'll see if it gets repealed and wound back. That's, I think, what we're all hoping on at the moment.
Yep.
Some other legislation coming out, which will in fact impact, sorry, property investors, will be the trust legislation. We still
Hmm.
haven't seen the draft on that. Right now, it is open up for consultation throughout July, and then we should see the draft, I would say, in August, and then it'll be unpacked and deliberated on, and we'll see. We'll see what the design of that looks like. But yeah, it's interesting. I mean, rents are pushing up, but it's also a difficult market for renters as well because housing, I guess, housing affordability, but not just housing affordability. We've still got a housing crisis, and vacancy rates are so low that you are still turning up to open houses, and usually you're still up against quite a few people. But it's definitely cooled off. Often we don't see too many new vacancies popping up through this period. The sort of typical cycle is usually spring and summer, is that when those sort of 12-month ones come up, that's when there's a lot more heat. So we're likely seeing that a little bit also feeding into some of these rental review numbers. We've got to remember that the federal budget, it certainly removed negative gearing for purchases of existing housing stock from that 1 July 2027, but directly relevant to investor clients right now. And I guess the scenario that we're going to talk about very soon.
Yeah, I mean, I think what's also interesting to sort of focus and highlight is obviously with these changes, it's not removing people's ability to deduct that interest. It just means
Mm,
if there's a loss, you can't necessarily claim that against other sources of income and it just gets
mm,
carried forward. But what you see now with these rents increasing and a softening of the asset price, we're going to get to a point where the yields are going to start to look quite juicy in some of these markets. So if
mm.
you look at, say, a Sydney market, some of those blue chip areas, the yields have always been on real terms being quite low. But if
Yeah.
we have a cycle through where rents are increasing, prices are softening, it'll get to a point where investors will say, actually, this is starting to stack up and be positively geared, and they're going to jump back into it because the negative
Yep.
gearing doesn't apply anymore.
Yeah, I think also just pivoting away from that, I think towards the end of the year, we should look back and see how commercial property has performed
Yep.
in the last 6 months, the half two, because I want to know whether there's been an investor shift into commercial because of the policy changes. We ordinarily don't talk too much about commercial property because most of our clients are mainly focused on the resi side. But I just want to deep dive a little bit into the data there. So I'm calling out on the podcast today just as a general reminder that we jump into it towards the end of the year because I reckon we'll
Yep.
see a bit of a shift there. Yields might even push up a little bit, but also capital growth might sort of pick up pace within the commercial sector. So we'll come back on that one. Absolutely. But yeah, no, it's a good one to make note of.
Right. And then we've got whilst we wait for some of those key bits of info come later this month, we've got a number of sort of Q&A. And well, firstly, we've got a bit of a client scenario we want to talk
Yep.
through that we're working on.
Yeah, absolutely. Now this is one I mean, I know obviously you're working on really recently, and it's about the concept of equity releases and how they can be used. I think I might get you to just run us through initially and
Yep.
explain like what is an equity release?
Yep. So, well, in this scenario, it's quite unique. And when you're looking with some of our potentially older, more established clients, they may not be working. They may have got
Yep.
themselves into a position where they've got enough assets, excuse me, to cover off their living expenses and essentially, what do they call it? Fire, retire, and just live off their
Yep.
passive income.
Financial independence, retire early. Yep.
So
Fire.
fantastic for them. But then when they get to a point where potentially they want to, excuse me, get another property or they want to upgrade a property and do that on their terms, of course, it doesn't look great to the bank when they don't have any wage income or business income. They've just got their investment
No.
income. So so in this scenario, the client had a existing property unencumbered for about 1.5 mil and looking
Mhm.
to acquire a property for about 2.5 to 3 mil. So this is going to be a place that they could reside in the next couple of years once they've sorted out their tax affairs. So it's very hard to go to a traditional lender to say, I'm living overseas, I'm paying my overseas rent, my overseas outgoings. I don't have any
Hmm.
wage income. I've got my assets that I'm earning income off. How do we show that to the bank? So there's some lenders that we can work with where they'll look at essentially an equity release looking at the asset values of the properties only. So not necessarily look at serviceability. They'll say, okay, well, what do we owe on the existing property? What are we trying to purchase? And they can take sort of a 35, 40% stake in that property. Now,
Hmm.
the reason why you'd look at that is it's because the way it's structured. So there's no repayments. There's what you call a deferred fee. So it gives
Yep.
people that flexibility to still claim the interest on that loan on an accruals basis, but that's not compounding. The interest is charged, every year on the agreed upon interest rate.
Yep.
And then when they're ready, they've changed their tax position, they've sold down some of those assets to exit the debt, they can do that on their terms. So it can work out to have a substantially better tax outcome because you're using the leverage up front and you're being
Yeah.
able to control when you sell down those assets to get out of that debt.
Yeah, I mean, I can see this being used in a lot of different ways, to be honest. One that comes to mind is actually funding and getting into an aged care facility.
Yep.
We see this time and time again where our clients might have a great deal of equity within their current house. They might not be retired yet, or they might be just retiring. So there's this income change where, they're not going to price up as well as they would have previously from a serviceability point of view, but they are trying to move also their elderly parents into, say, a aged care facility, and they've got to sort of fund that accommodation deposit. And often that might mean, okay, we have to unlock a bit of equity to use that to put them into that home. That's a really common one that we've seen probably in the last, I would say, probably 2 years, to be honest. We've noticed a lot of clients having to return back to Australia temporarily to help get their parents into aged care facilities or retirement homes just because they need some help, some assisted living. So we're seeing that as a common solution. But not only that, the ability to unlock this equity and capital for investment purposes, support retirement, support maybe an idea of another nice to do if you've got the asset base, but seen a lot of people starting to look at, investing in sort of these small sort of, I want to call them holiday homes over in Italy and a few other places because what they're going for price-wise is just dirt cheap, 1 or 2 bedroom sort of apartment down
Yep.
in the Sicily sort of region or something like that for a couple of $100,000. But by doing so, you get this sort of 12-month elective visa as well. So it's giving them a chance to maybe do something which they never thought they actually could do. So it definitely unlocks a lot of amazing opportunities. And it's just working with you. And I would say a lot of people don't actually know that this kind of product even exists.
Yeah, it's quite a new product. And the way it works is one of the key differences between, say, a reverse mortgage where the interest is compounding. This is simple interest, but the lender will take what you call a deferred fee.
Mm.
And they'll say, what's the value of the property when we start? It could be year one. What's the
Yep.
value when we exit? And that could be, say, year four.
Yep.
And depending on the LVR that we've taken out over that period, if there's growth in that property, the lender they'll share that upside. Of course, if the
Yep.
property doesn't grow over that 4 or 5 year period, then you sort of don't have any fee to pay. And if it goes backwards, similar. But it's
Yep.
essentially you're going into that transaction, and if there's upside, you have to share some of that upside with the lender, which I think
Yep.
when people get their head around the structure of it, if that property that you've held on to has done well whilst doing that product, then I think it's it's definitely common sense to look at that type of structure as well.
Yep. Yeah, especially when your servicing doesn't price up like an ordinary loan or mortgage. Like it's providing a unique solution to what I would say is probably a common problem, to be honest.
Yep.
Not having those repayments to be made, the fee and the amount just builds on itself, so it accumulates. And then once you sell it, it's cleared. It also means you're not having to pull other money out of your retirement assets, like your cash flow. It's not damaging your cash flow for funding your actual retirement. It's mainly there's an adjustment that will happen when you sell that asset and move into something smaller, such as a downsizing event, which is very
Yep.
common when we're in retirement. So yeah, can see it as a unique product for what is often a common sort of, I guess, problem that
Yep.
often a lot of clients, especially the elderly, need to solve. So that's great. It's a good example there.
And so now we've got some questions come in from the
Yep.
listeners as well.
We do.
Um,
Yep.
we'll go through
Yep. So
those.
I might frame these up for you, mate, because I'm not going to be able to answer these ones. But question one here, we are first home buyers in the United Kingdom, in UK.
Yep.
Um, should we get a pre-approval if we're looking to purchase in the next 6 months?
Yes. So in this scenario, went through the clients, they we kind of put together some credit advice. They were looking at a property. The property still went recently over their budget. They were
Mm,
anticipating around that sort of 900, sold for 1.1. So it was a little bit of a sticker shock for them. And then they're sort of umming and ahhing around, okay, well, we're still looking, but should we get a pre-approval? And my advice is obviously yes, because once you sort of go through that process, particularly as an expat, it's going to take a couple more weeks to get that pre-approval. It's valid for 3 months. So then
mm.
if they're actively looking the market, they can then execute on that purchase with confidence versus sitting on the fence and thinking, okay, I might wait another 3 months. Credit policy might change in that period. Serviceability might tighten up again, and things may change in terms of your borrowing capacity in 3 months' time. So yes, my answer to that would be definitely go ahead with the pre-approval.
Yeah, 100%. I think they're great, to be honest. Obviously, getting it now just means the process is so much smoother when you actually find that property,
Yep.
working with a broker closely on it, giving them updates as you go through the process, submit offers, just so they're good to go to support you. Um, Also making sure you get some advice, or if you need advice, reach out for that advice, especially when it comes to just like the terms that you want to put on the contract. If you're doing still sort of a 7 or 15-day or 14-day sort of finance clause with building and pest, and then, a 30-day, 60-day, 90-day settlement, get the advice you need to support that kind of contract of sale. Next question here. I'm no longer working, but my investment portfolio gives me substantial dividend and interest income. Can I still get a mortgage?
Yep. So again, really good question. It does depend on where that income is sourced. So
Yep.
if it's held in Australia in investment portfolios in Australian platforms,
Yep.
particularly if it's recorded on the Australian tax return, that's great. And it depends on the lender's credit policy and how comfortable they are. Some banks
Mm.
want to see that recorded on an Australian tax return for 2 years to verify. Some are happy to look at your current holding statements or maybe average over the last couple of years. But yes,
Mhm.
we can use that income for serviceability, which I think a lot of people assume they can't.
Yep.
Um, I would caveat that by saying if you've got income hidden in offshore accounts, which some
Mm.
expats do, if it's hard to verify in general, the banks are not going to accept that type of income. So
Yep.
you sort of need to have that verification down pat for the banks to keep them comfortable.
Yeah, and I think some good examples of just that is you might, depending on sort of the industry that you work in, if you're over in the Middle East, but you're employed, but maybe you do some sort of consulting on the side as well. But because you're in the Middle East, there's nowhere to really declare that because it's just consulting income. You might have a self-employed sort of business set up on the side. It's going to be hard for probably that income to be included in your serviceability. But compared to your wage income, which, you're going to have pay slips for, you can get it all documented. You've got an employer, you can get letters, all those sort of things. So yeah, understanding sort of probably the probability of the income being accepted by a lender back in Australia. Obviously, that's why you use someone like Jeremy in the team. But yes, different risk levels applied from different creditors on that front. But
Yep.
that's a good question. Good question. Good one here from Hong Kong. So I'm a permanent resident. I'm living in Hong Kong. Will the foreign buyer surcharge apply if I purchase in Queensland? So I might just reframe that one again. I'm a
Australian permanent resident. Yep. Live in Hong Kong.
charge apply if I purchase in Queensland.
Correct. Yep. So Australian permanent resident. So again, we just need to qualify that by where you're buying in the state, because that's where we'll just defer back to the Revenue Office and their definitions at the state level. So let's say you're buying in New South Wales, you would be classified as a foreign person per the definition of New South Wales. So you would be subject to that additional foreign acquirer duty.
Yep.
But in this example, they are looking to buy into Queensland, so they'd still be considered just a non-foreign person per their definition. So it would not
Yep.
apply.
Yeah,
And I think
absolutely.
I was working through this exact question with a client recently, and they're speaking to their solicitor, and you just have to be mindful that it does come down to the state. So if that client was looking to buy into Queensland, then they found an opportunity in New South Wales, that answer changes.
Yeah. So it's this question, it's so timely. And this is a bit of a side story for the listeners, but we work closely with a number of US accountants, and one of the client scenarios that we're working through right now is a Australian citizen and a non-Australian citizen, sort of a permanent resident holder. They are coming back from the United States and they're trying to avoid this exit tax, which can occur in the US. And they essentially have to give up their permanent residency in the US, and that can trigger this exit tax. Now, there's a common sort of gifting strategy that you can use between spouses to get yourself below this required asset threshold to be able to avoid what's called this exit tax. In this scenario, the strategy would be to gift from the Australian citizen to the permanent resident this cash to get the Australian citizen under this threshold to avoid the exit tax. But they want to use the cash to buy a property in New South Wales. And because they live over in the US, it throws up a bit of an issue because that permanent resident of Australia who's now living in the US still, they don't want to buy the property in New South Wales because of obviously the additional 8 or 9% that they get hit with. So it's like, oh, we might have to now wait, be in Australia for 200 days before we can buy, but they want to buy right now, but they need to navigate also on the other side this exit tax. So yes, each state, territory, different rules around foreign acquirers, the surcharge, the purchaser duty. So definitely do your research, seek advice from a qualified solicitor. A lot of the information is online. It's just understanding the strict definitions that apply and being able to unpack those. But that's a great question.
And I have seen multiple examples where conveyancers and solicitors can get this wrong because,
That'll
you
do
might
it.
be engaged with someone that predominantly just deals with people in Australia as a purchase transaction,
Yep.
which is fine. And this is quite unique. So I guess it doesn't hurt to get a second opinion as well.
Yeah, that's right. And often when you are back in Australia and you've obviously settled back in Australia, let's say you buy the property in the Australian citizen's name and it becomes your home immediately. Remember, most states and territories have what's called this love transaction exemption, which allows you to add your spouse onto the main residence without incurring transfer duty or stamp duty again. So once they've been in Australia, once they've secured their permanent residency or even Australian citizenship and they've been there for more than 200 days, depending on the state or territory requirement, you can then add them to the title without an issue. So yeah, being really mindful of that. Tanya Popperwell from eProperty Law, she's great with this sort of stuff as well. We've brought her on the podcast a few years ago. So just one that you should be mindful of when you are looking to buy a property and one of you is not a citizen of Australia yet.
Yep. Yep. Well said. Well said. Well, that's it for the questions. A little bit of a shout out. Ben Turner and I have an upcoming webinar at the end of August, September. We'll have the dates out in the newsletter.
Yep.
We'll be unpacking in detail around post-budget. What does it mean for financing and tax as an expat, buying property, holding property, different structures. So we'll go through that in detail. So that should be a great webinar. So please look out for those register details. We'd love to see you on that as well.
Yeah, absolutely. That's timely, especially after the back of the CGT changes. We'll know a bit more around the trust changes and what's proposed. Get on that one. Get your questions ready. Putting these two in the hot seat, and they're going to unpack it all with you on that webinar. We'll be putting that out in the socials very soon. So get your radio in early and get your questions in.
Looking forward to it.
Beautiful.
Thank you, James. Thank you guys for listening. Until then, we will see you on the socials.
Sounds good. Thanks, guys. See you soon.